Hi, today I'm taking a closer look at Adobe, the software company that has brought us most famously Photoshop. People who use Adobe products are most likely graphic designers, app developers, students, and serious social media people. Now, before you go look at the share price, let me save you the time. Like a lot of software and internet-related businesses, Adobe has had a really good few years. But although the stock price has gone crazy, it might actually be still a good opportunity for a lot of people. And for those who are new to my channel, well, welcome aboard. What I do when I analyze a company is I take a look at the industry they are in, the competitive forces they face, the management team running the business, then my valuation and my opinion. Now, unfortunately, 90% of all investors lose money. So I hope to help some people understand what it is they're actually buying. So Adobe is a recurring revenue cloud software business, and I like these types of businesses a lot. They generally have fantastic gross margins because they build the software and sell it over and over again. Now, Adobe isn't just Photoshop. They do have enterprise clients that they help with online advertising and e-commerce. But look, the Creative Cloud part is about 3/4 of their business. Adobe Creative Cloud products have been at the right place at the right time. The rise of Instagram and digital advertising has been a big tailwind for Photoshop. The only problem regarding the industry they are in is that they are already a massive company with a market cap well over $200 billion. Regardless, growth rates are still expected to keep moving along at about 15% per annum for the foreseeable future. Alright, so a big reason why I'm making this video in the first place is because some of my favorite investors are invested in Adobe. Chuck Akers' 11th biggest holding is Adobe. Stephen Mandel at Lone Pine Capital has Adobe as his 7th largest holding, and he recently added more. So they think it is good buying even in the last quarter. Then we have David Tepper at Appaloosa also added a little more to his stake in Adobe. Daniel Loeb at Third Point actually just reduced his stake in Adobe by about 30%. Maybe they think it's actually overvalued. This is definitely a who's who of superstar investors. They have a lot of experience, great track records, and large, sophisticated research departments. I personally have 0 research departments and definitely don't have the combined 100 years of experience like these guys. So this is a big tick of approval that it's a good company. Now, it's not like there aren't just a million Photoshop-like apps on your phone, but not many programs have the ability to do the incredible work like Adobe's products. There is a large switching cost moat that Adobe has with their products. When you get a job as a graphic designer or at a digital agency, you are expected to have this skill set. Now, of course, someone could come along and compete more seriously for the Adobe market, but this barrier to entry is really high. With most professionals already familiar with Adobe products, switching to new software, well, we all know that sucks. And with gross margins consistently over 85%, this is truly a money printing machine. This is a great business. And with the growth in book value looking perfect, that's enough to tell us how good this company is. Probably one of the best I have seen. Shantanu Narayan is the CEO, but he isn't the founder. Founder-led companies tend to be better, but with over $200 million in stock and only $1 million a year as his salary, his incentives are in line with the stock price. Now that's great, as he is in the same position as the shareholders, which is really important. Here's a table showing the return on invested capital and solid ROIC percentage numbers here. I like seeing this above 15%, and the 5-year average is above that, so all is good. ROIC is the ability for the company to grow the business effectively. It measures how well the company spends its money in new projects and what return they get from these new activities. It's a great number to look at as a sign of good management and a business that is compounding. Now, with their debt levels, well, they're low and there's nothing to worry about. And with over $5 billion of cash in the bank, which is more than all of their long-term debt, they're very safe here. Management are doing a good job and the business is about as stable as it can be. The lower the price, the more upside potential we have, plus the less risk we take. So price is unbelievably important. Now, I like minimizing my risk, so the best way to do that is to pay a price lower than fair value, and the further away from fair value, the better. Okay, now I've made this little table, and it firstly refers to the price to free cash flow, which is the relationship between the stock price and how much free cash flow the company is making. I then factor in growth rates to get a target price to free cash flow number. Look, this is a very rough way to value a company, but it is pretty good to get a ballpark figure and to then compare that with my next method, which is the discounted cash flow method. The issue is though that predicting future growth rates is when things normally get really difficult. But in this case for Adobe, with their recurring revenue, well, that makes life a lot easier. Yahoo analysts think 16% growth rate per annum over the next 5 years, and Zacks analysts think about 19%. So I'm going to go with 15% to play this on the safe side, but all these numbers are within 5% of each other, which is pretty stable. Sometimes I see companies and someone thinks it's 30% and others think it's 5% and then 50% and negative 10%. And it's really hard to get growth rates for the future. So being somewhere between 16 and 19% is pretty stable. So according to my table, I would want a price to free cash flow number somewhere between 10 and 25. Currently, in March, it's about 40. So we are overvalued based on this metric, and probably about 50% overvalued. Now, if I look at my fair value calculator, which factors in more information, and if you want a copy of this, it's free and in the description. Now, I'm using 15% growth rates and then a little less after that. I even used a big multiple of 25, far above what I would normally use because this is a software company and the PE at 25 can be justified. So $250 would be a pretty good price in my opinion, still about 40% away from its current levels. Now what I've done here is I've now changed that growth rate to 19% and a future PE of 30, which is totally achievable. So now buying at about $300 is a good price. This might be a good entry point, but I still would prefer that $250 if I got that price. For those serious about Adobe, somewhere in this range is probably not a bad place to start. Okay, so the negatives for this investment are, the market cap is already over $200 billion. Look, I personally am looking for companies under $1 billion, so look, this is far out of my range. It's obviously overvalued. Like most companies I'm finding at the moment, we would need a good old market correction to get some solid entry points. The problem with paying too much is that the odds are just not in our favor. There is just not a lot of upside. The company can grow at 15%, but the stock price might only grow at 5% for the next decade because of this overvaluation. But the positives are many. Recurring revenue software businesses don't get much better than this. They have good compounding metrics. That ROIC percentage is solid. The switching costs are high. Changing software sucks, and Adobe products are ingrained into students and professionals now for decades. They're very profitable and gross margins are insanely high. My favorite investors are invested with TIKR, Mandel, Tepper, and Loeb are all smarter than me and more experienced than me. So following these guys is pretty smart. And then Shantanu Narayan, the CEO, is heavily invested as well, aligning management and the shareholders nicely. So do I think Adobe is a good company to invest in? This appears at the moment to be an incredible company, one of the best I've analyzed. But look, it's not for me. Market cap is too big for the portfolio that I'm building. Plus the price is nowhere near a bargain. But I would totally support anyone who was aggressively buying Adobe at a good price like $250. If you bought in at that level, you could forget about it for a decade and it would probably be totally fine. Look, it's not going to go up 100x or anything, but it's going to be solid. Now don't forget to subscribe to my channel so you don't miss the future videos. Hit me up in the comments if you have an opinion about Adobe. I love hearing both sides of this story. And obviously you will need to investigate a lot further if you want to invest yourself, but this hopefully gets you started. Thanks for staying to the end and I'll see you in the next video.